Yeah, I do think it's going to continue until we have a currency and a sovereign debt crisis. I mean, it shows you how ridiculous it is that so much depends on a few words spoken by Powell, or a couple of changes to a statement or a dot plot, and all of this determines whether we buy or sell. I mean, the Fed should just be irrelevant in the background. I remember once upon a time nobody even knew who the Fed chairman was. I mean, a lot of people didn't even know what the Fed was. And now, there may be more people who know the chairman of the Fed than know who the vice president is. And it's not supposed to be that way. But it's become a very political office. And everybody looks to the Fed to solve problems. In fact, you had all these politicians, they think the Fed is there to solve the inequality, or they don't like the distribution of wealth. It's too highly concentrated, or there's too much unemployment in the African American community. And they ask the Fed, what are you going to do about it? There are people asking the Fed what they're going to do about climate change. Like, well, what do they have? They have a printing press. All they can do is create inflation. You can't solve the world's problems with inflation, but temporarily you can make it look like they went away because, all the numbers go up. Everybody thinks they're rich, right? When you print a bunch of money and everybody thinks that now they're rich because they've got more money. But the problem is then prices go way up and you don't have more purchasing power. And we're at that stage right now. The prices are starting to catch up to the money.
In a recent interview, renowned economist Peter Schiff warns of an impending sovereign debt crisis, emphasizing the absurdity of market swings based on Fed announcements. He notes the growing politicization of the Fed and its ineffectiveness in addressing systemic issues like inequality or climate change. With gold steadily rising and silver poised for significant gains, Schiff predicts silver may hit $50 an ounce before gold reaches $3,000, citing central banks' neglect of silver. Despite record highs in gold prices, retail outflows from gold ETFs signal a misunderstanding among investors, indicating further potential for the rally. As Wall Street focuses on speculative assets like Bitcoin ETFs, Schiff underscores the overlooked strength in gold and silver markets.
I mean, silver was really bound to take off. It was near 90 to 1 with gold, record lows. Gold was marching higher, really from 2000 to 2200, 2300-ish. And silver hadn't even moved. Silver was still below 25. And then all of a sudden it spiked up to 30, pulled back a bit. But I think now silver is broken out and it's joined gold and will ultimately eclipse gold as far as the percentage gains, not the price, but I think, percentage wise, I think that silver could hit $50 an ounce before gold hits 3,000. And so that's a much bigger gain for the price of silver than the price of gold. But again, I think the reason was the central banks. They weren't buying silver. They were just buying gold. They don't have room to store silver. And also the central banks aren't investing in the mining stocks. So, it's the retail public and institutions that might have been investing, and they were not. Again, they don't understand it. They think that gold or silver should be going down because it's a soft landing. Everything is great. Buy the Magnificent Seven. And those who are worried, well, they were buying Bitcoin. I think that the launch of these Bitcoin ETFs really, provided that smokescreen, because when everybody should have been talking about gold's rally, they were talking about these Bitcoin ETFs, which were the most successful ETFs as far as how much money went into them. They're not going to be successful from the point of view of the people who were dumb enough to buy them. It's going to be a complete failure. But Wall Street did, sucker in a lot of speculators, so they're making money for now in these ETFs. But I was actually watching during that first month or so we're trading, like there was 1 week where gold went sideways and gold stocks were down like 15%. And it was like, well, what's going on? And I thought, well, maybe people are selling off their gold stocks to buy the Bitcoin ETFs because the money had to come from somewhere. And in fact, all year, we've had record outflows out of GLD, which is the biggest gold ETF. at the same time where gold prices are running up to record highs. And normally it's the opposite. Normally the retailers are chasing a rally. They're not selling into the rally. And so what that tells me is that they've got it wrong. This rally has legs. It has a long way to go. It's not going to be until we have huge inflows from the retail public that we're probably going to get a significant correction. Probably not even a bear market at this stage, but we could have a 5 or 10% correction if the public jumps in. But so far, they're still selling. There was one Wall Street firm, Bank of America, last week that upgraded Freeport-McMoRan to a buy, which is probably more copper than gold. But that's the first, buy I saw on a miner. But no one has upgraded any of the gold stocks from where they were. I mean, if they had them as a buy, they're still at a buy. But the people that were a neutral or a hold or an underweight, they haven't said anything. They haven't revised upward their forecasts and their ratings.
Peter Schiff continues by highlighting the undervaluation of gold stocks amidst inflationary pressures. While gold prices have lagged behind rising mining costs, recent trends show improved margins for mining companies, signaling a potential opportunity for investors. Schiff advises considering the Europe Pacific Gold Fund managed by Adrian Day for exposure to this sector, and stresses the importance of owning physical gold and silver as inflation hedges. Don't miss out on this unique opportunity to capitalize on precious metals.
I think that these stocks are still incredibly cheap. Gold stocks have been the ironic victim of inflation. You would normally think, oh, high inflation, that's good for gold miners. The problem is the investors haven't really recognized how bad the inflation threat is, and they haven't bid up gold prices enough, but the cost of mining has gone up dramatically. Most gold companies are making less money today mining gold at 2,400 than they were mining it at 500 because of the increase in energy costs and labor costs. But what nobody seems to notice is that recently now, gold prices are outstripping the gains in a lot of other commodities. And the dollar has stayed firm, meaning the gold price in terms of other currencies has actually risen faster than it has in dollars. And most mining companies, their wages are in those other currencies. So the margins, I think, over the last few months have really improved rather remarkably in these gold stocks. And so I would be looking for that to be reflected in their earnings that come out. And maybe that'll be a catalyst or a wake-up call to Wall Street to buy these stocks. But before they get that wake-up call, while they're still sleeping, I would advise your listeners to be moving heavily into this segment, recognizing it is a risky segment. So, don't put money in there that you absolutely can't afford to lose. But if you do have risk capital, this is what risk capital is for, because the upside potential, I think, dwarfs the downside risk. I think it's a unique opportunity to make, stellar returns. And you can do it yourself, or you can hire me. In fact, I didn't even do it myself. I hired Adrian Day. You've had him on your program. Adrian manages the Europe Pacific Gold Fund. You can buy that no load at any discount brokerage firm. EPGIX, I believe, is the no load symbol. It's the institutional class of the Europe Pacific Gold Fund. I think Adrian has built an incredible portfolio. We've got some really good juniors in there that I think are going to be, the 50, 100 baggers of this bull market. But I think the seniors are still going to go up 10x, before this thing is over. But you can get a lot of exposure if you have a larger portfolio. We have separately managed accounts at Europe Pacific Asset Management. You can visit me at europacfunds.com or europac.com, even shorter, and talk to our representatives there about us managing a portfolio for you in the mining space. We do separately managed accounts. And of course, don't overlook owning the physical metal. I mean, I think there's more upside potential in the miners right now, but of course, there's more risk there as well. But everybody should own some physical gold and silver in particular right now. And you could get that from shiftgold.com. That's my gold company, and I think we've got the best prices and the best service. We've got personal service at discount prices, and we don't push people into numismatics or anything like that. We recognize that you're not buying gold to become a coin collector. I mean, if you're a coin collector, okay, that's totally different. I'm not knocking collecting coins or collecting art or anything else. But if you just want an inflation hedge, if you want to get out of fiat currency and have savings in metal, you don't need to become a coin collector. You just need to buy the most gold and silver you can for your money. And that's with bullion.
Today's discussion with Peter Schiff sheds light on the concerning dependency of markets on Federal Reserve actions and the looming threat of a sovereign debt crisis. Schiff emphasizes the risks posed by inflation and the potential for significant gains in gold and silver investments. He underscores the importance of considering exposure to gold stocks, recommending the Europe Pacific Gold Fund managed by Adrian Day. Remember, investing involves risks, so be sure to do your research and make informed decisions.